Everyone's got a plan until they get punched in the face. No truer words have ever been spoken, not just about risk and business, but about viewing nature of reality in general. And they come from none other than our friend, the former heavyweight boxing champ, Iron Mike Tyson. Now you may ask, well, what does risk management, running a business, have to do with getting punched in the face? And more importantly, what I want to talk about today, which is the statement of cash flows. Cash is the ultimate reality check. Cash is how we evaluate businesses, not based on income or net profit, but actual cash flows. You can think of cash as the ultimate reality check on any business. A mentor once told me that rule number one of success is as follows. You look around and you see who's doing the best, and then so you imitate the best until you're getting consistent results on your own. So naturally, when I got interested in investing, learning about business, I looked around and I saw, well, who's the GOAT? Who's the best? And lo and behold, it's Warren Buffett. Now, it's become commonplace on Wall Street now to follow something called free cash flow. But Buffett was doing that way back in the day, in the 60s, 70s, 80s, before Wall Street actually caught on. He actually calls this owner's earnings. Owner's earnings, what Buffett calls owner's earnings, is pretty much cash flow on steroids. What you're doing is, there's a complicated formula to calculate it, but the quick and dirty way is you take operating cash flow from your statement of cash flows and you subtract out any capital expenditures. So basically it's operating cash flow less net capex. It's cash flows that actually determine the valuation of your business. It's not revenues, it's not income, net profit, it's actually cash flows. Now, a lot of small and medium-sized businesses use cash-based accounting, and that's perfectly fine. But what happens is, if down the road, if you want to get top dollar for your business, if you want to sell it for that elite 7-8 figure valuation, have a good exit, what you really should think about doing is switching from cash to accrual accounting. Now, accrual accounting is dictated by GAAP rules, and there are some specific things you have to keep in mind. So you're allowed to recognize revenue when you deliver the product or service. But again, you don't collect on it right away. So there's a gap between when you actually deliver the service or product and when you collect the cash. And that gap is what leads us to the statement of cash flows. Now, there could be many reasons for why the gap exists, but you can think of it as in three big ways. First one, right, there's just going to be a delay. Most businesses do 30 days receivable, 210 net 30. You can also, if you're a new company, you could have prepaid expenses such as insurance, rent. And the third one is if you just have a big capital expenditure. Say if you bought a fancy new equipment or truck for your business, now the cash has already been paid, but it's going to show up little by little on the income statement. You're going to take a small sliver of that every month over the useful life of that asset and depreciate it. But the important thing to keep in mind is that there's a difference between profit as reported on the income statement and the actual cash, or more specifically, the timing of the cash. For our clients, we actually model out the internal rate of return, the IRR, and the NPV, or the net present value. This helps you stay focused and gives the best possible answer as to the question of whether or not I should take on this project. You need both. You need profits and you need cash flow, but it's important to understand the difference. A lot of businesses fail within the first year because of cash flow problems. They simply just run out of cash. Now, the statement of cash flow has three big parts: activities from operations, from investing, and from financing. And we'll tackle this in another video. But for now, the key takeaway that I want you to go home with today is this. The ultimate number for your business, if you're using accrual accounting, is going to be free cash flows. And a quick and dirty way to estimate this or eyeball this is take operating cash flows and subtract out net capex, or capital expenditures. We will tackle how to actually do the statement of cash flow step by step in another video. I'll close by just saying this. One of the great management thinkers of our time, Peter Drucker, said that a corporation or a business has only two jobs: one, innovation, and second, sales and marketing. Well, to that one, I would add a third, and that is management of cash flows. If you don't do this, you're risking the death of your business. It is that important. Okay, and if you found this useful, if you need some help with your accounting, bookkeeping, if you want somebody to help you switch from cash to accrual, to help you analyze your financial statements and give you a little bit of an insight on how best to grow your business, increase your profitability, so we can get you to that elite 7-8 figure valuation level. Give us a call. We'd love to help you. We're here to help. You can check us out on our website, www.patelbookkeeping.com, or give us a call at 223-306-2110. Okay, talk to you soon. Bye.